syndicating a single family home isn't really feasible. And so I said, okay, we have to do it to where it's scale, it makes sense, and I can put relationships first, not trying to extract everything out of it and actually have a job to be able to create. And so that was a bigger shift that happened during the pandemic. 2022 is when I started to focus on commercial.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder, and CEO of Zana Investments, Tim Little. Today we have with us Deren Huang. Over the last 5 years, Deren has bought over 100 residential units in Tulsa, Oklahoma. Tired of the midnight calls, especially the ones from the police, he has now shifted his focus to commercial real estate, specifically industrial. He now has over 100,000 square feet of triple net lease space. Deren, welcome to the show.
Hey, thank you so much for having me. I appreciate it.
Yeah, and it's great to have you on. As I've talked about before, this is obviously a multifamily focused show, but we like to throw a little variety in there as well. We know we're not the only show in town. So I gave everyone a high level overview of your background, but we really like to get into the details of how you got started on your journey. So please take us back to the beginning and tell us how you got to where you are today.
Yeah. So in 2016, I actually got licensed as a real estate agent. I thought that I was just going to be in the residential space, helping people find and buy homes, and then maybe having a buyer's broker underneath me, building out a team. And then ultimately, on the entrepreneurial journey, I thought that I was going to own my own brokerage. But it wasn't until about 2017 that I picked up my first investor client. And man, he was a breath of fresh air because he didn't really care about the granite color or the paint colors or this backyard isn't as big for my dog and stuff like that. He just cared about the numbers. And he was a repeat customer. So he was always buying and wanting a ton of volume and a ton of houses as long as they made sense. And so that just really opened my eyes and shifted very quickly to just investment sales on the residential side. And he sideways mentored me because he took me full cycle through a BRRRR strategy single family home, which stands for buy, renovate, rent out, refinance, get your money back out, and then repeat it. And so, that was in 2017. So, that's my journey and my first start into the real estate investing world.
All right. Yeah. And I can attest that it is certainly not easy to find a real estate agent who understands and let alone focuses on investments, right? So my first real estate investing purchase was a duplex. And it was not easy to find someone who understood what I was trying to do because they're so focused on the primary residence, which makes sense. And I get it. But I think it's a missed opportunity for a lot of realtors if they can niche down, I guess is the best way to put it, and apply that skill set to what the demand that's there for those investors. So thank you for filling that void for someone else at least.
Yeah,
All right.
but that was short lived too, because it only took like about a year until I started seeing, once again, I saw that deal full cycle and I was like, oh my gosh, this is actually true. And so at the end of 2017, I made my first investment. So even though you're thanking me, it probably shouldn't be thanked because it was really quick when I transitioned out of being an agent. Yeah.
Yeah, and that's an important point, I think, because so many, not only realtors, but also brokers do it as their full time job because that's what it is. But they never take that step to transition into being an investor. And so I guess I would ask you, what was different about your case where you saw it and you're like, obviously, hey, this makes sense. And you understood the concepts. What led you to take action?
Yeah. So I think initially it was that I was still a little bit young in my journey of real estate. So being a broker, you can get some really great fees and you can make a really great living. But once again, I started a little bit earlier and my eyes got opened just a year into my career. So that was one of the factors too. But yeah, you're incredibly right because a lot of brokers, a lot of real estate, they don't actually invest. And what they do is they're just a hamster on a wheel, all their commissions, and then they pay for marketing. And yes, maybe your return on investment is a little bit better, but you're still working that job. What kind of set apart was one, we were in Tulsa, Oklahoma at that time. The affordability for housing, it was really low. So my first investment, I bought for $75,000. Whereas if I was on the coast or somewhere with a higher cost of living, maybe that entry level home is $500,000. And once again, I was in the right location, was sideways mentored by my investor friend now. And yeah, all that kind of just meshed together, being young in the career and then also not having too many responsibilities. I think that all helped when it comes to actually jumping onto the principal side of the equation.
Yeah, and I think you hit on an important point that pretty much stops a lot of people before they ever get started is they don't think it's possible when they start looking at the prices on some of the properties that they're looking at. So when I first got started, I was living in Washington, D.C. I probably don't need to tell anyone that's a really expensive market. I know because I had to buy a house there. But when I was looking to buy my first investment property, I was like, I can't do this. It's just not going to happen in the DC area, especially when all the banks were telling me they needed a 25% down payment for that. So what did I have to? I could have just said, "Oh, this is hard," and just quit right there. But what I did is looked outside concentric circles to say, "Okay, how far do I need to go before it is affordable?" And I had to go a couple hours out, but I was able to find something reasonable in Richmond, Virginia, about a 2 hour drive away, but certainly reasonable for taking a weekend out to go check out some properties. And I was able to find a duplex for 85,000, which seems crazy in retrospect, but rougher neighborhood at the time. This is 20 2014, I think. So prices were lower as well. But again, it's just getting past that limiting belief of, oh, this is hard or oh, it's too expensive, and really trying to find ways to make it happen versus the myriad of reasons why it can't happen.
Definitely. I totally agree. Yeah. So being either creative in the actual purchase or yeah, maybe finding an hour or two away suburb or a different city or town that is a little bit more affordable. That those are great tips to breadcrumbs to pick up on, I would say.
Yeah, and so let's fast forward a little bit, right? So you got that first property. What happened next?
Yeah, I basically got addicted. So I bought that first property, and once again, I saw this full cycle, and it was pretty fast. And once again, bought it. 6 months later, I was able to refinance out, and I got that initial money back. And so I said, "How do I do not just one at a time, but two at a time, and then three at a time?" I basically capped out at three or four at a time, but had multiple projects going on. And so that was the question that I had. And the other questions that I had was like, how do I get to scale to where I can have in-house property management, in-house crews, different things along those lines. And so that was the question that I had. And once again, being about 2016, 2017, you could still find things. And if you dug into the MLS or did, some off-market research and prospecting, you were still able to get some deals. And yeah, once again, quickly transitioned out of the agent role, the broker role, and wanted to be a principal. So basically, what that looked like was I did that first one, got my money back out just from the Burr refinance and said, okay, let me use the capital that I initially used and then maybe use hard money. And so that allowed me to do two at a time. And then, oh, we took down this package deal and maybe I partnered with a couple people with this, 5 unit project and stuff like that. And so that just started to snowball and snowball up until about 2022, where I decided I wanted to get into commercial real estate specifically. And I didn't really know what I was looking for, but I landed in industrial. Yeah.
No, that's interesting. You alluded to some of the challenges that arise as you start to scale. But I would like to hear a little bit more about, I think the first hurdle that people talk about is that like 10 mortgage hurdle, right? Like it's hard to get over that. Tell me if that was an issue for you, and if so, how you got past that. Because I think that's the first hurdle that especially, newer investors run into.
Yeah, definitely. Getting out of the Fannie Freddie residential home is really scary just because when you go to the commercial style, you usually have a higher interest rate. It's not fixed for the full entire amortization, and they usually cut down the amortization to 20 instead of 30. Usual term loans, and obviously these can differ quite bit, but usually it's a 5 year fixed period, 20-year amortization, and so usually the interest rates are higher for sure. And so that just meant that I had to find better homes. And yeah, transitioning from some of the 30-year fixed rate mortgages into that commercial style loan just meant that I had to either add value in a better way, usually in construction, sometimes in the lease up, maybe on the path of progress, so in different areas. But then also the cost basis of buying it had to be really important. So you had to dig deeper for better deals and maybe add more value by adding on to the home, or not just a paint and floors remodel, but to the studs. So as I took on more complicated projects, maybe even adding a second story, adding on to the homes, I was able to bring the valuation to where I had a ton of equity, and then it still cash flowed on some of those limiting terms, 20-year amortization, higher interest rates, different things along those lines. So that was the initial hurdle. But once again, I just felt like I was stacking skills. That's the hurdle that I had to jump through to be able to get some of the equity and to still cash flow.
Yeah, no, there's definitely some good nuggets in there. You talked about moving over to different types of loan products, maybe a little higher risk, but then you were mitigating that risk by having higher upside. So, were these mostly like distressed properties or were they okay?
Yeah, so at first I started just in kind of the suburb brick 3-2, 3-1, stuff like that. But as I progressed into that residential, it was those add-ons and to the studs and pop topping, making that second story and stuff like that. So that's where it got a little bit more complex for sure. Yeah, most of my assets are distressed, were distressed. And sometimes it was one of them I took over a portfolio that the owner had a really great cost basis in, and rents were $750 where they should have been 1,000, 1,100. And so sometime I just took on the risk of not cash flowing for the first 6 months until I was able to wait out the lease. And so I would say there's a distress in either the cause of the actual structure of the home, but then also sometimes in the lease terms too. But most of it was a value add project, I would say.
Okay. Yeah, we are going to transition onto the commercial side, but before we go there, I want to
Yeah.
understand the systems that you had to put into place in order to scale because I can't imagine you it would be possible without putting the systems in. Again, you talked about maybe having in-house property management, maybe in-house renovation slash construction. Talk to me about what that looked like for you and your company.
Yeah, yeah. So on the front end, I had my license, so I could do everything. I could be the acquisition person. I could also be the leasing person, the property manager. So I was that uh, allowed me to scale to about 20-ish properties. But by then, I didn't have any children. I was just married, so I had a lot of time too, and I really enjoyed that hustle. But as I was like, "Need to scale more," exactly what you said. I had to hire people and train them, and that's a whole totally another skill of leadership and then also understanding different dynamics. So, as I scaled, the first one was the property leasing agent, and so she was a hybrid, she managed some stuff, she also leased out some stuff, but some of the systems in place that I had to put, I didn't have any systems because it was just me doing everything. So, I had to write down everything along those lines, and since she was in-house, I had to teach her get lock boxes and everything that you can think of, anything and everything that you could have think of to actually get those systems in place to get a well-oiled machine and then actually add in and replace myself as things came up. But yeah, it was about 20 units that I made my first hire, had to be on the leasing side. So she did a lot of the paperwork, a lot of the showings just to free up some of that time. But basically, I was for the first year, I was just like running around with like a chicken with his heads cut off just because I was doing everything, acquisitions, the construction management, I was making the Lowe's runs, I was doing the security system, like all this other stuff too, until I was able to find that team and actually gain that traction and then make some equity, get the cash flow going too. Yeah.
Yeah, and I think that's such an important point, and not just for single family, but for multifamily, commercial, for anything. Once you learn how to scale by implementing systems, making those hires that allow you to extract yourself out of some of these, I guess, less money making processes. So where you can apply yourself where it makes the most sense and earns the most value, that's a huge value to have. And once you learn that skill, that's when you really start to blow up. So I appreciate you giving us insight on that because again, that's applicable to almost any entrepreneurial endeavor in general. So what would you say was the impetus for you making this the shift from those single family houses over to the commercial side?
Yeah, so there's a couple things. During COVID, I took a mini retirement just based on the cash flow. So the goal that I was chasing was financial freedom. And that was really a self-serving goal just because I wasn't able to share the wealth of real estate. I stopped helping clients out too. And I took the mini retirement and I was really dissatisfied. One, because it was the middle of pandemic. So there's some anxiety and fear and all these things that kind of layered on to the actual mini retirement. But ultimately, I think that people are created to work and to make impact. And so the change from single family to commercial, and initially I was thinking multifamily or mobile home park, was to be able to focus on relationships and actually spread the wealth of real estate. And that was mostly, I was thinking that would be done joint ventures, syndication, different things along those lines. And syndicating a single family home isn't really feasible. And so I said, okay, we have to do it to where it's scale, it makes sense, and I can put relationships first, not trying to extract everything out of it and actually have a job to be able to create. And so that was a bigger shift that happened during the pandemic. 2022 is when I started to focus on commercial.
Wow, yeah, that's so interesting because when people get into real estate, yeah, almost every time you're gonna hear, "Yeah, trying to hit my freedom number," whatever that is, and it's really about options, right? Having the options to work or not to work. So it's interesting that you found when you're like, "Hell yeah, I put in all this work up front. I'm gonna take this mini retirement," and not finding that sense of satisfaction. I think your situation is probably not uncommon for anyone, under a certain age, of course, who does retire early and they're like, This is not what I wanted at all." And so that the fact that manifested when you coming back and discovering that you wanted to add value, partner with others, and really get that engagement with other people is interesting. Talk to me about why you went to commercial specifically. You mentioned some of the other asset classes. Obviously, multifamily is a very popular one, and it's one of my favorites for a lot of reasons. But you talked about some of the other options that are out there too. There's warehouse, there's mobile home parks, there's all numbers of different retail, stuff like that. Why did you settle on commercial as the or on industrial as the commercial asset of choice, I should say?
Yeah. So, yeah, the beginning of 2022, even the end of 2021, I was searching. I was looking for mostly multifamily just because that has the residential space is what I knew. I had a couple small multis that had done pretty well, but I didn't really know the structure and how to put things together. And so I felt like I didn't want to be trend chasing just because multifamily had really gotten pretty hot. Mobile home parks back in 2018, 19 ish had really gotten hot too. And I thought that I really wanted to find something that could help people out, maybe a C class to B class conversion, mobile home parks, allowing for affordability and affordable housing. But what really stole my heart in industrial was just the economic factors of it. And then also I just felt like I have a competitive edge in that. But yeah, towards the beginning of 2022, I really didn't know what I was doing. I just knew that I wanted to syndicate and help people and joint venture with people and focus on relationships too, just because real estate had changed my life. I remember even trying to, like, put in bids for, like, hotels to apartment conversions or office to apartment conversions, but they never really gained traction, and I wasn't able to put those together. But industrial is something that crept out of, like, third base, like, I wasn't even expecting it, but as I learned about myself and just knowing myself, some of those competitive edges that I can put just really put like that to the forefront. And then I decided to fully focus on industrial.
All right. And just so, everyone has the same picture in mind, tell us what industrial really is.
Yeah. So industrial real estate is categorized into three different categories. The first is what you mentioned before, which is the warehousing. That has really exploded over the past couple years because if you imagine 10, 20, 30 years ago, there wasn't a need to put a package on your doorstep in less than 2 days. And so the rise of e-commerce has really pushed that up. So think of Amazon or FedEx or USPS as that warehouse. A lot of trucks or trains or airplanes even too to help the distribution space. So that's the first one, warehousing. The second one is manufacturing. So this is taking the raw goods and actually turning it into something usable. One of my tenants turns plastics into the plastic jugs. And so they manufacture that. Usually it's categorized by high ceilings, or not high ceilings, but just heavy power. And then usually there is some distribution just because they do have to move that around. For example, a tenant like that, we have here in Tulsa something called Kimberly Clark. So they make paper products. They have brands like Bounty and diapers like Huggies. So they make all those things and then they send it to their distribution center. So that's manufacturing. And the third is flex space. And that's a catch all because like even medical research facilities fall under the flex space. But when I think of flex space, think of the like the Sherwin Williams that you shop at. It has like retail and then a little bit of office, and then that majority is the warehouse so they can keep all their paints. And then technically they have some manufacturing because they add the colors to the paint and mix it all up and stuff like that. So that's a very flexible flex industrial property. So yeah, those are the three categories of industrial real estate.
Nice. Okay. You said warehouse, manufacturing, and flex. All right. So talk to me a little bit about what an investment in this type of property looks like. Are these primarily syndications, just like they would be on the multifamily side of things? And if that's the case, I would assume you wouldn't be doing them if you didn't get the returns required to pay investors and make it attractive to investors. Talk through that a little bit for me.
Yeah, so this space is actually really fragmented, and that's one of the reasons why I actually like this because in multifamily and usually RV parks or mobile home parks or anything residential, if you have multiple units, you can't actually occupy the whole entire thing. So these are mostly investment properties. Whereas for industrial, you actually can have owner users and then also the investment properties that are just pure investments. So combining the two and using some of the local advantages that I have, I'm able to arbitrage in between those. I would say the majority of industrial real estate on the smaller scale is going to be that owner user. Whereas now some of these larger distribution spaces are like really institutional. These are funds, these are syndications, these are really high level players playing in this space. Think of the people that are leasing to Amazon versus the mom and pop shop that just needs to distribute a specialty product to your door. I would say the majority, it depends on which class that you're playing in, but yeah, that's the arbitrage and a fragmentation that can be taken advantage of.
Okay, I got it. And I guess which do you find yourself servicing more? Do you focus more on the investment side, or are you looking at just the owner? Was it owner user?
Owner user. Yeah. So I look at basically anything just because I believe there is an arbitrage because if an owner users, you can do so many different things. There's an industry term called a sale leaseback. And there's also maybe them vacating the space and you can demise it or take an end user and fill it in and able to add some value that way. In the past couple deals that I've done, mostly what I call joint ventures or a tenant in common to where I'm able to pool funds and purchase the actual asset and then distribute some of those things. So I wouldn't say that I focus on singular asset class or a style, but right now I am just in Tulsa and only looking in the areas in this area.
And with those tenant in common deals, are you bringing on 1031 investors into those?
Yeah, they're able to, and that's what makes the tenant in common really attractive is that you can 1031 in and out of those without having to keep in the same LLC. And so for some of them, so in the particular deal that I'm thinking of, no one did, but we did take some IRA and the money and stuff like that. But yeah, very similar to where the general partner really managing, having all these abilities, I obviously found the deal, different things along those lines. So where the tenant in common comes in play is that they are passive investors and they're able to get those returns a little bit. And it was a smaller deal, and that's why we did it that way. But yeah.
Yeah, and that's very similar on the multifamily side. It's just onerous administratively and legally. So you don't see it as often. So I was just curious if that's something
Mhm.
that is more common on the industrial side.
Yeah, I wouldn't say that it goes either way. There's not a lot. I wouldn't say that actually once again, the market is fairly fragmented. The owner user is not going to be using any syndication or joint venture or anything along those lines. It's usually just them with the SBA loan sometimes, or even a local bank financing them. Whereas some of the higher level things like an Amazon warehouse is going to be like a fund or a syndication or something along those lines. So you can see where there's some opportunity to be able to maybe bring in a fund or a syndication or high level joint ventures and stuff like that. So yeah, that's what one of the reasons why I'm really excited about industrial.
Yeah, and I guess just to crystallize it for us, can you walk us through a deal that you've done and explain to the compensation from your side, just so that we can understand how it differs from other things?
Yeah, so this particular deal we did last year. I'll just say the previous deal that I did, it was a smaller warehouse. So it was only about 9,000 square feet. It was brought to me off market and I negotiated a nine cap. And I know like when people hear that, their jaws just drop. So yes, it is uncommon to actually have that high of a cap rate, especially in a secondary or primary city. But I negotiated hard. And once again, we walked into a lease. That's why. So this one had 5 years left, or it was a 5 year lease. There's 4 years still left on it. And so we really wanted to capitalize on it. So since it was a smaller deal, only about $500,000, $500,000, we didn't want to take it SEC and get the exemptions and blah, 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 and really bloat it with the legal fees. So we just set up a tenant in common. So we raised capital, people were able to put in their money. And this particular one, it was once again at the end of the year. There's a lot of interest rates. A lot of people didn't know what was going to happen. So we just raised this one full cash. So nine cap, we are distributing 8% from day one. We walked into the lease. And yeah, for my compensation, I was able to get a little bit acquisition fee and a disposition fee. Once again, since it's a triple net lease, really didn't have that much asset management except for some reporting. So we went light on those fees. So yeah, that was the particular deal that we just recently did. A little bit uncommon, but we can't pass up a nine cap.
Yeah, and you talked about a triple net lease. Just for the audience members who might not be familiar with that, can you go ahead and define that for us?
Yeah, so triple net lease is a really amazing tool, and I honestly thought they were like fake when I first started, just because it felt outlandish, especially coming from the residential side. So the triple nets means that the actual owner nets all the rent. So the tenant actually pays for the property insurance, the property taxes, and all common area maintenance. And so the base rent is truly what you should net because the tenant is paying for all those expenses.
Okay, awesome. And obviously, that's attractive just because it's less heavy lift, right? Yeah. Less headaches, less to worry about. So, yeah, I can certainly see that. From the investor perspective, you mentioned, I think it was like a pref starting day one. Can you just explain traditionally what those returns look like for investors in these types of deals, just so we can understand again how it might differ from mobile home parks or multifamily?
Yeah, so this one, once again, since it was so small, we just did a joint venture to where whatever percentage that you own, you get. And so this one wasn't really set up to where there was a preferred return or a waterfall or anything along those lines, just because, once again, a lot of people don't really know about the industrial space. So I just wanted to make them feel comfortable. So I said, hey, listen, here are the shares. Here's how much money you're putting in. This is your percentage of it, and then we keep a little bit back for any reserves or vacancy or any legal thing that would maybe happen if we needed to have that. So we started, it was a nine cap, and then we just took 1% off as reserves. And so people are getting 8% based on their shares. So it might be like 7.99, but yeah, still something along those lines. But yeah, that was that particular one. I would say that most of our syndications and or other larger deals, we usually pay, yeah, anywhere in between a 7 or 8% preferred return. And then we split very similar to you guys, like a 70-30, 30% to the general partners, 70% to the limited partners, depending on how big the deal is and different things along those lines. But this one, since it was so small, we just wanted to make it very easy and attractive. And yeah, hopefully we did that.
Yeah, no, that all makes sense. I'm thinking about it, and it seems to me that you guys would be able to start paying like right off the bat, which is a little different, obviously, from multifamily, specifically value add, where you have this time that's required to either turn over a tenant base or to do renovations before you can raise rents, et cetera, et cetera. Is that the case? Can you usually start pushing off those distributions day one?
Yeah, so this particular one, once again, we walked into a lease. It was a single tenant too. We closed December 27th. The tenant paid January 1st. And then for me, I wanted to rush that distribution because I was really excited. And so we distributed that first distribution on January 5th. So yeah, that turnaround time was really quick just because we walked into it. So you can imagine a sale leaseback, something very similar to that. But we do have value add projects within industrial real estate to where we have to turn over things or we have to maybe lease rents or something along those lines. So it could go either way depending on the style and the type of deal that you want to invest in, specifically industrial.
Okay. Yeah. Sounds like there's a lot of variety, like you said, even within the category, much the same as like commercial multifamily. All right. This has been some super interesting conversation. We're broadening our horizons here, and I love it. But we do need to move on to the turbo rounds. So I'm going to ask you the three questions that I ask every guest that I have on my show, and I just ask you for a quick, honest answer. The first one: what is a red flag every investor should look out?
Yeah, so this is something that I'm currently going through just because I am a little bit newer into the career of actually raising capital and building out my team, even though I had one on the back end for the residential one. But I went really light on fees for my first couple raises. And a lot of people gave me grief. They were really excited, but that's not a sustainable way of actually building out a business. So I want to work with a great team, a really talented team. And if I'm cutting my fees off, I'm not able to work with people like that. And so I would say that is actually a red flag for people waiving fees. So I would have done it differently. And I would have been, a lot of my mentors are telling me, hey, listen, maybe for the first couple ones, you got to do it this way where you cut your fees. But yeah, that's a red flag actually. So you have to count the cost and actually understand if they're building a business or is it just a one-off for them.
Yeah, no, it's a really important point that I think a lot of people don't talk about because there's this fear of letting the investors know that we get compensated for all the work that we're doing, which seems bizarre to me. It's not like you would ask anyone else to work and not get compensated for it. But you're right. So there's a couple of problems with it, right? Like it can send different signals. One, I think you're absolutely right about the level of service that you can provide if you're getting the fees necessary to build and grow out the capabilities of your business, whether that's the relations, being able to answer things more quickly, or have the robust CRM, investment platform, whatever the case may be. All those things cost money. And if you're trying to skim and pay as little as possible to get things done, then you're probably going to get a level of service that's commensurate to that. So from the investor's perspective, you're hurting them just as much as you're hurting yourself by not getting those payments. And then two, some, I'd say probably more experienced investors may look at that and say, oh, this must be a really skinny deal. If that guy, girl is trying to keep their fees low, that means there must not be enough meat on the bone for them to compensate themselves fairly. Almost counterintuitive, but that's another red flag from the investor perspective that, hey, there's not enough there for them to compensate themselves fairly, let alone pay me. And so that their danger meter may be going off there. And so it's really important to have that balance. You obviously can't go in the other direction, 5%, 6% asset management fees and nickel and diming all over the place with just random fees. But I think you're right that especially new syndicators, GPs, whatever you want to call them, they tend to skew the opposite way because they think it's what investors want to see. But for all the reasons you already mentioned, it may wind up hurting them more.
Yeah. And if you actually take a longer term scope to your investing, you don't just want to do one deal with a really experienced and great operator. You want to see them grow. You want to see their business grow. And investing is just not a one-off thing. You're going to get this money one time. No, usually you want to reinvest things and you actually want to see that platform and their business actually really take off too. And for people that are like, hey, why don't you cut your fees and stuff like that, that might not be a really great relationship. Now, once again, I am like definitely not trying to tell you don't do the deal or put a ton of fees in there. But yeah, you got to think about yourself. You got to think about the talent you want to hire. And then, yeah, a long-term focus on your business too. So that might be a little bit weird of thinking that way. But yeah, I think that's something that I'm going through right now, being a little bit younger in my career too. Yeah, I think you hit the nail on the head. So it's really interesting that we flipped that script. Yeah.
Yeah, that's key right there. All right. What is a myth about this business that you would like to set straight?
Yeah, so a myth that I would say is that you got to do it yourself. A A lot of these type A personalities, even towards the beginning of my career, I was just doing things all by myself and just paying myself out of the promote, which is not great, or paying myself out of not taking any fees or anything along those lines. And so if you try to do everything yourself, you're going to fail because you're not going to be great at everything. The myth is you can do everything yourself. That is really false. You need to think with a team, you got to think long term, and you got to think of relationships.
Yeah, absolutely. All right. The final question. What does success look like to you?
Yeah, so that's ever changing, especially during this past couple years as I decided to help people. So the things that I'm dreaming about now is just having some really great returns and being able to bring some really unique asset classes and buildings to people that normally wouldn't be able to. And I think about that Amazon warehouse. Am I even able to buy that Amazon warehouse if I had the money? No, those are usually in like exclusive circles for funds and for institutional money. That's what success looks like for me in the future professionally.
Yeah, I like that. Definition of success evolves as you. All right. Hey, this has been super interesting. I know I learned a lot, so hopefully the audience learned a lot as well. Please tell our guests how they can get a hold of you and if there's anything else that you'd like to share with them.
Yeah, so the best way to reach me is my website, DerenHuang.com. So you can actually do two things. You can immediately book a call with me and get on my schedule, or you can also sign up for my newsletter and get access to exclusive deals. So that's the best way to get in touch with me, DerenHuang.com.
All right. We will definitely have all of that information in the show notes. Darren, I appreciate you coming on, and I look forward to seeing you do big things on your journey to commercial real estate millions. Have a good one.
Thank you.